Want to show you a brand new strategy called momentum reversals. I'm going to show you where it was a few months ago. I've been watching this. The market has more V reversals now than it's ever had, and so I like this. This setup does not work before May of 2020, so it only works about a year and a half. When I first started trading, I only had 18 months of data, so I used strategies with just 18 months of data. And so basically this looks for the market to be oversold, and then it looks for a momentum reversal, and we see how well this would have done this past week. And again, I developed this a few months ago, 3 or 4 months ago. I don't have the exact date. I develop a lot of strategies and I let them sit on the shelf, and this was developed at least 3 or 4 months ago. And so this is what it's done recently. This is what it looks like. I have improvements for it as of Thursday night. Before Friday's trade, I made some improvements on this strategy. Here's what the equity curve looks like. I'm going to improve this now, and I'm going to tell you how I improve this. And so it's basically based on a weekly stop loss. This uses a $1,200 stop loss, but this raw strategy did not even have a stop loss. So it has 78.15 as the largest losing trade. We're adding a $1,200 stop loss and a monthly stop loss and a maximum daily entries of 3. I'm going to pause the video and show you the improvement. It's 558. That's going to double. This drawdown is going to get cut down. Huge average trade profit for a day trade strategy. So only going back to May 2020, I'm going to show you that it does work during some time periods before that. And then here it is on the E-mini S&P. It works on the E-mini S&P as well. It goes long and short. So you see the short trade, the long trade, and it's hard to when you have a strategy like this to say, let's use it because it only has a year and a half of data. So we're going to also put it in the portfolio calculator to see how it would work with the portfolios in this video. So I'm going to update let's look at the ES results. 194 average trade profit, 400% net profit as a percentage of drawdown, 36.87 largest losing trade. I'm going to update the code to add the stop loss, the monthly stop loss, and the max daily entries, and show you how it improves this strategy. So here is how this works with the Nasdaq. It goes to from 106,000 to 109,000. It goes to 310 trades because you can have a max daily entry of 3. And now that we have a stop loss, this does not include slippage and commission. I'll add that for the portfolio calculator. 351 average trade profit. So huge average trade profit. This is not a situation where if you add slippage and commission, this strategy will not work because the average trade profit is so large. Drawdown gets cut in half, which means the net profit as a percentage of drawdown doubles. Equity curve looks really good. And we're going to look at it prior to May of 2020 and say, can we justify trading a strategy that only worked since the pandemic? Are we in a new regime? Should we take into consideration strategies that do better with momentum reversals? Markets oversold, momentum goes up, you can catch a rally. Markets overbought, momentum rolls down, you can catch a short trade. On Thursday, the market sold off hard, and a lot of our strategies just didn't trade that day. We had 60-minute breakout short on the ES, took 3 trades, but it would have been better to have more trades. A lot of the things about Thursday's rally this past Thursday, January the 13th, was that it was pointed higher. A lot of the things that we normally look at say that the trend is up, and so it did not take short trades. And then yesterday on Friday, January the 14th, it took a long trade, which was stopped out, and then it reversed and took another long trade. Let's look at the ES now. ES, it's positive on the ES as well, and the average trade profit is 183. Drawdown is 8,000, and the net profit as a percentage of drawdown is 501. Probably be able to use a tighter stop loss on the ES. We have a gap continuation and reverse strategy that uses a $1,000 stop loss, and it was stopped out by 2 points. It was 2 points from the low yesterday, so we're in a situation where we have to use slightly larger stops, and maybe going down to micros is a good solution if these stop losses are too high. So like I said, this only works back to May of 2020. I'm going to pause the video. I'm going to change the dates, and show you the results prior to that time frame. Before I do, I want to show you the fact that how well the short side has worked. $109,000. Half of $109,000 is $54,500. So if you're going to divide it up evenly between long and shorts, 54,500 would be the middle point. You see 57,165, 51,835. It's a very simple strategy, and it works really well on the stock indexes. Better on the long side. We've had definitely more upside since the beginning of the pandemic, but because it's really hard to find a strategy that goes short, and this has done it, and it's done it differently because the market trades differently on the downside than it has in the past. And so you get these down days when the market is pointed up without much warning, and this will capture a quick momentum trade when it's overbought, and that is a little different than what we've seen in the past. So let's pause the video, look at it going back to 2007. So here is going back to 2007, how this works. It doesn't do terrible. It does okay in here, and then from about the beginning of 2016 until about the end of 2018, this does well. November 2018, I know we had that taper tantrum at the end of 2018, and then it doesn't do well from the end of 2018 until here is where Fed stimulus starts, March 23rd of 2020. Right in here is where the massive Fed stimulus starts, massive new index levels. We have to consider that we're at new index levels and that the market trades differently now than it has in the past in some ways as far as reversing against its trend and a bigger point value. Since there's bigger point values, you have more room for reversals than we have in the past. So for example, if the Nasdaq was at 5,000 in the past and now it's at 15,000, it has to make 3 times as large of a move to do the same percentage move of its closing price. And so a 50-point move is 1% of the Nasdaq when the Nasdaq is at 5,000. A 150-point move is 1% of the Nasdaq when it's at 15,000. So when the moves are larger, the way volatility can change around different price levels, and so when volatility changes, market patterns can change, and so that's part of what we're seeing. We're seeing large stimulus, but we're also seeing higher index levels for the first time, and so lots of volatility that I think will continue. And so this is a strategy to consider. I'm going to put it in the portfolio calculator. You can test it back all the way back to 2007. And you can also, take a look at what it's done. I do like the fact that it has almost as much short profits as it does long profits since May of 2020. Let's look at the long versus short now. It's about split. 82,400 is the total, and 41,200 would be halfway. Would be the halfway point, and so you're a little above it on the long side. 44,280. And you get 38,120, and so the market has trended higher over the years. So certainly the long side is going to do better. The average trade profit is higher on the short side if you go back to 2007 because there's less short trades. And so those are some observations on this strategy. I'm going to add it to the portfolio calculator with slippage and commission. And let's look at the ES now, going back to 2007. I'm going to pause the video and change the date going back to 2007. Here it is. Before, if we go back to May of 2020, let's look at it back to 2007. I haven't looked at this yet, so I'm going to do this for the first time, looking back to 2007. So I've changed the date on this, but this did not update. So sometimes you have to click on this button right here to get the data to reload. So the data is going back to 2007, but the results haven't changed. So let's click on this, and so we'll see 9,000 versus a $36,000 drawdown. And you can see that it's a little more volatile. Doesn't work as well historically in the E-mini S&P, but works great since May of 2020. And so we have to consider new regime type strategies, emerging strategies like we have in the past. And I'm going to add them to the portfolio calculator. If you're in the all strategy access, you're going to get this strategy and have the option to trade it. And if it's added to one of the portfolios and you have one of the portfolios that it's added to, you will get this strategy as well. I'm going to add it to the portfolio calculator next and then show you how it looks in the portfolio calculator. Once we add slippage and commission, you can see the equity curve is amazing still in the Nasdaq. Since May of 2020, before that, it's down. And so you have to ask yourself questions like, why does a strategy pattern that has never worked in the past all of a sudden work really well? And is it worth trading? So you add it to the portfolio calculator. And this just highlights the nature of the changing nature of the market. You know, this kind of pattern works really well now, but it didn't work in the past. So is the market different now? And you have to, in certain ways, and so you have to think about applying this to a new portfolio. ES, same way. It doesn't look quite as good because it's still net negative, and maybe this is the end of this pattern. Maybe it's coming up here to this resistance level. If you look at the equity curve like you do a chart and say it's going to stop working now and it's going to go back to its old ways. So you want to wait for a couple of losers, a little bit of a drawdown before you add these. I'm going to show you how it looks in the portfolio calculator. And so, for example, here is the portfolio calculator with the updated strategies added, not to a portfolio, but in the portfolio calculator list. Momentum Reversal 2022 ES through Friday, January the 14th, 2022, and Momentum Reversal NQ 2022. And we're going to take a look at that. Once again, it has a weekly stop loss of $2,400. So if you're down 2 trades net, you are done for the week. We've had strategies that have monthly stop losses. This has a weekly stop loss, so that's good. What would happen if we added to the 200K portfolio? It would be you would have much better results. But you would take it, for example, your worst case drawdown would increase by about 3,000, and your risk to worst case drawdown would be 25,000. So I wouldn't jump in now. Maybe at the next equity peak you jump in, you say it increases the worst case drawdown, but the worst case drawdown happened back here in a less relevant time period. The further away we move from, say, 2011, 11 years ago. And then in recent years, let's see, since 2016, 24,760. versus 26K. What is this one? This one is 24,160. This one is 26,332. So the worst case drawdown holds unless we go back more than 10 years. Then it increases about 3,000. But let's wait for an equity peak to start. Otherwise, we increase our risk to worst case drawdown from about 5,000 to about 25,000. So let's wait for the current strategies to recover somewhat. They've taken a beating and then add this, or wait for the current strategy to pull back a little bit. It's at an equity peak. We don't just want to jump in and increase our risk to worst case drawdown. How does this look if we add this to the, I have to click the undo button because I broke the formula. You see the formula for this is right here. And so you don't want to, you don't want to break that formula. If you do, you have to use the undo button. So 200. Let's look at the stock index portfolio. Thinking about switching to the stock index portfolio for the 200K portfolio. Its risk to worst case drawdown is about 4,000. It only trades the stock indexes. It is about $4,000 away from a worst case drawdown in this new year already. And let's look at adding Momentum Reversal 2022. And you see that the worst case drawdown remains, but your risk to worst case drawdown increases because this one has done well. And so you have to find a way to phase in, wait for the current strategy to recover a little bit, or this one to pull back a little bit. You can't just jump in at equity peaks, so you have to wait a little bit. So this one would have done much better. Let's add the ES version. Let's see. That one would probably really increase the worst case drawdown. Let's see. It's much different. It trades much differently than anything else, so it may not increase the worst case drawdown a lot. It doesn't. It doesn't increase the worst case drawdown a lot. It goes from around the 24K range to around the 26K range. If you add both of these, even though the ES strategy is net negative, you can look at the drawdown curve. Faster recoveries recently with this new setup. So we are going to wait. We're looking at adding this, but we're going to wait. And I'll let you know when. If you hit the All Strategy Access, you're going to receive this setup. You could trade it if you wanted. You could just jump in take a chance that it's just going to keep running up. And so it does do well long short trade since May. Another strategy that does well on long and short trades is the Cobra 2022 NQ strategy. And let's look at that Cobra NQ 2022 right here. Let's look at it in terms of the stock index portfolio. And it really increases the worst case drawdown, because historically it doesn't work that well before the pandemic, but it works really well since the pandemic, and I've been looking for a way to get in on that one. This might be a time to, well, it's going to increase your risk to worst case drawdown back here, but not your risk to worst case drawdown in the last 10 years. So your worst case drawdown in the last 10 years is still 22,000. It reduces that. It reduces your drawdown on the perspective of the last 10 years in the stock index portfolio, and you're about 5K away. So that could be, if you're trading the stock index portfolio, take a look at this again. You want to click the undo button. Now your worst case drawdown is 35,000, but that is back here at old index levels, which are much lower. Different time period, 35,000. The last 10 years, the worst case drawdown is 22,000. And so if you click the undo button, you remove this Cobra 2022 NQ, you can see that your max drawdown is 24,092. Going back all the way to 2008, and your risk to worst case drawdown is about 4,000. If you click the add it back button, your worst case drawdown in the last 10 years is 22,000. So about the same risk to worst case drawdown the last 10 years. If you see what I'm saying, 22K the last 10 years is the max drawdown. Current drawdown is 17,730, 750. Then if we add this one, let's see what happens. Yeah, it really runs it back up, 53.85. The the worst case drawdown in the last 10 years is still about 22.5. So really strong equity curve because of momentum reversals. The momentum reversal strategy accomplishes the V reversal setups that we like to try to capture, that are difficult to capture, elusive V reversal strategies. This does that. Let's look at the 50K portfolio as well. The 50K portfolio is 88.60 drawdown, 10.157.50 max. And what happens if, so like if you look at this over the last 3 months, this is net negative. So we're up minus 2,000 there, 51.95. So the November, December, your net gain is about 3,200, and then you come into January, 78, 72.50. You're down about 4,300 the last 3 months. So it's kind of gone sideways the last 3 months. We've made equity peaks, but we haven't run at equity. We've made equity peak and just sharp pullback. Made an equity peak, sharp pullback. So we've made equity peaks just by a small amount. And overall, the last 3 months, since November 1, this is down about 3 or 4K. And then the drawdown is right here though, and it's been here before. So you have to trade in that risk tolerance. You shouldn't trade a portfolio if you're not willing to risk the worst case drawdown. I don't think you should just jump in here and risk $2,000 or $3,000 and get out. That's too sensitive to really ever have much success. You're just kind of guessing and gambling if you do that. But let's look at the 50K portfolio with momentum reversal ES. So really bumps up the max drawdown historically. Let's see how it looks recently. Yeah, I wouldn't want to do that. Let's look at it on the ES or the NQ. That was the ES. It would make it profitable. Really accelerating equity curve. It really bump up this. You have this drawdown though right here during the pandemic. 18,197, May 21, 2020. That's when this new strategy starts working really well. And so what's the worst case drawdown? Since this, besides that one drawdown, you get 11,422.50, which is about similar to the past, and just it's created massive gains in 2020, 2021, starting out strong in 2022. I mean, this could be the way to go. The problem is that it has you at an equity peak when you're really in an $8,800 drawdown. So even if you risk it to the second worst case drawdown, which is about 11.5, you're risking another 11K if you add this strategy, which isn't bad. This one strategy alone has about a 10K drawdown. And so this is becoming a long video on portfolio analysis. But I wanted to share with you my thoughts. You can add better strategies, but I believe in kind of a reflexive response where you let the current strategies bounce a little bit. You don't want to get in on an absolute spike down and then jump in that's at a spike up. You have to wait until it kind of resolves itself in a more sideways to up price action before you make changes at absolute extremes, jumping out on the spike down and jumping in on a spike up on something. So would not want to do that. So these are some of the things I'm looking at. These are the new strategies. If you have the all strategy access, once again, you'll be getting this setup, this momentum reversal setup, and you can trade it if you would like in any of your portfolios or by itself or in a custom portfolio of your selection. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.